Micron stock reported their earnings earlier this week that were better than many expected, yet still the stock went down because their outlook was weaker than expected, and their weak outlook caused a broader sell-off in sympathy with the semiconductor space, saying, hey, could this be part of a broader macro downturn? I'll talk about that later on in this video, but first let's try to understand, what does Micron, MU stock, even do? Because in order to figure out where does a stock potentially go in the future, you need to figure out what does the underlying business look like. If this is your first time tuning in, my name is Daniel. You're watching Unrivaled Investing, a no-hype, mission-focused channel trying to find you exceptional companies and unrivaled investments. So as we look at Micron, the way to think about it is their primary product is memory and storage. They talk about designing, developing, and manufacturing industry-leading memory and storage solutions, and how they're the fourth largest semiconductor company in the world. Their primary product, about 3/4 of their business, is dynamic random access memory, or DRAM, which when combined with a CPU effectively makes computers possible. They talk about when combined with a CPU, the ability to run sets of instructions, programs, and store working data becomes possible. Simply put, without these core products, the core storage and memory solutions that they provide, you wouldn't have basic computational abilities. You wouldn't have basic functional technology around you without the memory and storage solutions that Micron provides. But the reality is it's not just them. If you look at DRAM, and in this video I'm primarily focusing on their DRAM solution because that's about 3/4 of their business, you look at what they're selling, and the reality is it's an oligopoly. And that is what I like to see when you see that there's only a few different competitors. That means ideally it should be more rational over time. Now they're the smallest, let's say, of the top three when you look at them, where Samsung is a top dog. But it is generally, when you see a more concentrated industry, you're generally going to get more pricing discipline over time, or at least that's what you would expect. And you also have this sort of tailwind where you say, well, if you're offering memory and storage solutions, well, what's going to be the need for that? And you see the amount of data creation in, I think, zettabytes is just continued to grow at an exponential rate. So the world needs memory and storage solutions, and they break it down by individual categories as well, like data centers, and they can break it down based on their different products, about 3/4 DRAM, about 1/4 NAND. And you can see, for data center, this is a hyper growth segment where they think from fiscal 21 through 25, that's growing around 30% a year for both of these products, based on, in terms of bit demand, DRAM bit demand. If you look at mobile devices, somewhere between teens to 24%. I mean, you're looking at some very great growth rates. The slowest growth is with sort of the legacy categories like personal computers. But as you look at the Internet of Things, in industrials, you're looking at hyper growth rates. You look at autos, which is becoming increasingly connected. You're looking at crazy growth rate, 40 to 50% growth. So this all pencils out to increasing bit demand of effectively teens bit growth rate for DRAM and high 20s for their NAND. So this could pose, great growth potential for Micron in the years ahead. The biggest challenge is that long term, and if you look back over, let's say, from 2016 through 2021, their DRAM pricing is actually down 20%. And you see with NAND, it's been down nearly every single year from 2016 to 2021. So that's part of the concern here, is that this clearly reflects that they are a price taker. They are not, even though they operate in an oligopoly, they have to deal with continually declining pricing and that competitive dynamic. So even though there's only a few players, it is still a ruthlessly cutthroat environment. And part of the challenge is that you might be running, but you're still just running in place. And I think their financials really reflect that, where you look at, let's say, the last 3 of their fiscal years and you see, wow, this company's generating a lot of profits. And this is where a lot of folks are going to say, yeah, this trades at a cheap multiple to earnings. Because you look at it over the last 5 years, earnings, the earnings, the profitability is going to jump around 2.7 billion in 2020, 6.3 billion in fiscal 2019, 5.9 billion. So billions of dollars in terms of profitability, 15 billion cumulatively over the last 3 fiscal years. But the challenge is that they're constantly investing into sort of expanding their capacity for memory and storage solutions, which they have to do, that sort of running and keeping in place. They talk about investing 150 billion plus, tens of billions of dollars in manufacturing and R&D around the world to keep up with demand. But the reality is, do shareholders really benefit from that? And you look back over the last 3 fiscal years and you see that, yeah, they did 15 billion in net income, which is sort of this accounting figure. But when it comes to real free cash flow that shareholders could see, it was actually only $6 billion. So that's a huge difference, partly because they have to constantly reinvest into new property, plant and equipment, new expansion, just to sort of keep up, because pricing does keep going lower. So they have to constantly sell more. So the question is, where does Micron stock go in the future? First, super quick, where if you're looking for compelling investment ideas or want to take charge of your investment journey, consider unrivaledinvesting.com. Thank you to all the Unrivaled Investing subscribers that keep this channel going. And so part of the reason why Micron stock was down was because they had a weak outlook, and calling out particularly what they said. They were talking about industry bit demand growth has moderated since our last earnings call, seeing a significant reduction in near-term industry bit demand, primarily attributable to end demand weakness in consumer markets, i.e. we're seeing a weak consumer, including PC and smartphones. So it's not only the legacy PC market, which arguably had a nice bump because of, COVID, where a lot of people going home, hey, you need to order that PC, but smartphones as well. People just aren't replacing them as quickly. And they're talking about weakness in consumer spending. Once again, a weak consumer in China, Russia, Ukraine war, and rising inflation around the world. You're going to see this theme, I think, a lot around, various different industries where, as you have inflation, let's say with higher gas prices, people are going to have to make that trade-off. Oh, do I really need to get a new phone, or can I hold out for, let's say, a few more months because I don't really need it? And that's kind of what I think you're seeing here with this weaker consumer when they talk about that rising inflation. They also talk about the end demand in the mobile, PC, and consumer markets have weakened, but some of their core markets, being cloud, networking, automotive, and industrial markets, are showing resilience. So we'll see how that plays out for the rest of the year. So that is a nice component. Longer term, those segments should be more resilient, more profitable for their business versus the highly cyclical consumer markets. The challenge is their guidance reflects a lot more weakness than folks were expecting. So they did around 8.6 billion in revenue this most recent quarter. A lot of folks were expecting around 9 billion for the next quarter, but they guided to around 7.2 billion in revenue. So that's big difference, about $2 billion difference. And they had been operating at, let's say, around 30% plus profit margin. And now they're saying, yeah, the cycle's turning, folks. Now we're guiding to somewhere in the 20s. I'm penciling out somewhere in the high 20s, but it might end up being a lot lower. And that is scaring some investors, sort of saying, well, where does this sort of shake out in the future? And the reality is, you might start asking, well, is this just a Micron problem, or is this a broader industry problem? It's clearly a broader industry problem, because you see Samsung also in the headlines talking about sitting on 50 million unsold phones. And so this does mean largely that I think you should expect a broader semiconductor slowdown. This does sort of fit with the increasing calls for a recession. So what you're seeing here is, if you have all this inventory, then all that sort of capital expenditures that all these businesses have, these purchases that they make to expand capacity, that is not going to happen. And that's why the semiconductor industry is so volatile, is because you're making these purchases that are effectively one-time in nature. Hey, whenever you want to expand capacity, which you need to do because prices keep going down. And so they're looking at this. And so the challenge is, once you have inventory, then you completely cut it off. You say, hey, we don't need to, order any more new of these, or we're going to slow down on the purchases. That's the broader semiconductor sector. For them, you're going to see a dramatic slowdown, in terms of purchases, in terms of what they're looking at. And so that is creating a challenge, saying, hey, there's a weak consumer here. Now, what do I think about the valuation? Where do I think the stock goes potentially from here? Currently around a $60 billion valuation, a $60 billion market cap. And you could see, fiscal 18 was when they were at $30 billion, and they haven't been there since, until estimated this year, where they're supposed to beat it around 31 billion in revenue is what's expected. And then I'm penciling out somewhere between, let's say, 25 and 30% profit margins for them long term, thinking about what do they look like over the full market cycle. Currently, they're north of that, but now they're guiding to something that's in the 20s percentage. So I'm saying long term, let's think about this over several years. Their guidance has been around 30%. So I'm putting 25 to 30% for the margins, slapping on a 10% tax rate. Then the question is, well, what's the revenue growth rate in the years ahead? Yeah, they do have a very high expectation for their bit demand. Well, how's that actually translate into revenue when you see a lot of deflation in terms of their underlying products? Because it's effectively commodity products with declining prices over time. How does that actually translate into revenue? And you can see, for 2 years, 2019, 2020, you saw some substantial declines. Now, part of that was due to COVID, clearly. But the question is, so where does this sort of shake out in the years ahead? Are they able to grow much faster than, let's say, 7.5%? And that's really, if you're a Micron bull, you have to say, I have confidence that their revenue is going to be, let's say, double digits in the years ahead. And that's really what's going to drive it. And I think there's going to be, really a much higher multiple. I'm assuming a lower multiple here, partly because investors aren't actually seeing most of that free cash flow, most of that quote unquote earnings that they report. Their free cash flow is quite different than their earnings. And I talked about that earlier. Now keep in mind, this is a hypothetical valuation framework. Of course, stock price go way higher, way lower. A lot depends on their execution, broader sentiment, but I'm assuming a low multiple range because that cash doesn't actually end up in shareholder pockets most of the time, because it goes back into, hey, we got to go back into expansion. And also, this company, given that they are a price taker, effectively a commodity operator, you're not really looking at a company that should warrant, I'd argue, something like a 20 times earnings multiple. So I'm assuming a more conservative earnings multiple. The way to get an attractive return from here really would require margins to go back to where they were, around 30%. So recover from their outlook for this next quarter. Assume some earnings multiple expansion around 12 times earnings. Assume some high single digit growth. And if you're able to get these three components, 30% margins, 7.5% growth rate, and let's say a 12.5 times earnings multiple, then you're looking at 150% upside from here. Personally, I would rather try to find an unrivaled company, a type of company with pricing power over time, where I'm much more confident that they're going to be growing at an attractive clip for years to come, versus being in this sort of price taker position. That's a much tougher position to be in, unless there's a position like, if I'm going to look at a commodity, I'd want to make sure that there's sort of a structural shortage, so that way there's going to be high prices as far as the eye can see, and that they'll just be minting free cash flow. But when I see this sort of environment where they quickly have to change and say, yeah, the consumer weakness because of inflation is causing us to say our margins are going to get hit, that is a bit of concern. So I would want, before I would personally buy, I would want to see a lot more upside, with Micron stock. That said, I can understand why some value investors do like it, saying, hey, I effectively looking at this saying, yeah, based on a range of different scenarios, I'm assuming either break even to 150 to 150% upside, based on this range of scenarios, where one assumes effectively very little growth from here, structurally lower margins around 25% versus the over 30% that they've seen in the last few quarters, and an 8 times multiple. I'd say that's a fairly conservative assumption, let's say 5 years out. Now the stock price can be super volatile, but I think from a cover your butt perspective, there is this possibility that you're looking at a break-even situation, which for a lot of investors, that's what you want to cover yourself with. You want to say, hey, on the downside, I'm not going to lose too much. Long term, if I think these scenarios are achievable. And so I understand why some value investors would get excited about it. Personally, I want a little bit more growth. I want a little more upside for my own personal investment journey. If you enjoyed this video, please make a point of hitting that thumbs up, hit that subscribe button. Thanks so much for tuning in to Unrivaled Investing.